In Focus with Jeremy Szafron is brought to you by Swan, the real Bitcoin company.
Welcome back. I'm Jeremy Szafron. Now, today, we're looking at a market that's rallying at the index level while the core drivers of the U.S. economy lose momentum and the major indices are near record highs. Yet the average U.S. company isn't participating. Consumer spending just stalled in real terms and private credit margins continue to compress. And meanwhile, the Federal Reserve has quietly halted its balance sheet runoff, which tells you liquidity conditions are far tighter than the headlines suggest. And to add to that, Bitcoin has broken its decade-long correlation with equities, correcting sharply even as there are new reports that sovereign wealth funds are quietly accumulating behind the scenes. And meanwhile, gold is holding above $4,000, supported by central bank demand and reserve managers who are rethinking the reliability of long-term duration of sovereign debt. Now, this is not a normal market environment, and it's not a normal cycle. Investors are trying to navigate all of this. So, of course, we brought in somebody who knows a thing or two on the macro environment. And my guest today has been ahead of every major macro shift since 2019. Our latest research covers the rise of fiscal dominance, the growing risks in private credit, the, quote, utility trap in crypto, and the next phase of global liquidity, which she calls the gradual print. Joining me now is Lyn Alden. Lyn, welcome back to the show. Great to see you.
Happy to be here. Thanks for having me.
I want to talk to you a little bit about this disconnect. When investors look at the S&P 500, they obviously see markets making new highs. But when you remove the 7 mega caps, the remaining 493 companies look really nothing like that. A capital expenditure outside of the AI giants is really flat, and consumer spending has stalled here. So are we watching a market being held up by a handful of names, as we've discussed before, while the broader economy loses momentum? Explain where we're at in this moment. Is it a soft landing or is it just a mask?
So I think it's a little bit of both. I think as you described it, there's a narrowing. So the two main drivers holding up GDP growth are, one, the fiscal transfers. So we still are running above target, fiscal deficits as a percentage of GDP. And those are going to a segment of the economy. And then, of course, AI CapEx. And so any investment or trend that's generally on the right side of those forces is generally in pretty good shape. And a broader set of entities that are not really on the right side of those are suffering. They're dealing with tighter monetary policy, and they're not really getting the benefit of either AI spending or the fiscal transfers. So we have a narrowing of the economy. And as I kind of pointed out in my recent report, this is in some sense what you see in emerging markets. It's a little bit more stagflationary. It's a little bit different than a normal slowing economy that we see in developed markets because it's still coming with above target debasement, largely driven by that fiscal excess. And so it's more stagflationary rather than kind of the disinflation that we normally see during, kind of weaker economic periods.
Yeah, and Lyn, when we talk about the bearish side of things, I always get in trouble because the bulls push me back on this, and they say, they argue that the wealth effect is real, that the top 10% own the bulk of the assets, and they continue to spend. I mean, even if manufacturing is weaker, they'd say that the strength and service keeps the U.S. out of recession. Does that argument carry weight?
To some extent. I mean, that's why I'm not too bearish, because you have to ask, what else would you be long? Is it cash and bonds? Certainly around the margins, that can be useful for sell-offs, for volatility reduction. And I am more nervous around equities here than I was, a year or two ago. But that's kind of been my trend for a while, that there's multiple things to truly be bearish about. But you still generally want to be long scarcer things compared to abundant things. And it is true that, the top segment of society is responsible for a lot of the spending. They hold a lot of the assets. And so I generally describe the current macro environment as more of a social issue than a macro issue, meaning that there's political ramifications from the level of frustration that exists throughout the economy. But that's different from something that could kind of heavily sink stocks. Right now we see pretty much record divergence between near all-time high stock prices and near all-time low consumer sentiment going back many, many decades. The only other time we were in this kind of position was the really early 80s. When stocks were recovering and sentiment was still very low in a recession. So this is quite an unusual period, especially outside of recession. It's pretty much unprecedented. And so you see that narrowing effect, which is real, but it doesn't necessarily mean you want to short it.
Yeah. Yeah. Good point. I mean, you're saying macro has, become a kind of a social issue, that the economic story is now kind of inseparable from how people feel about their own financial stability. Of course, we're seeing that show up in the data. Consumer sentiment just rose for the first time in 5 months, but it's still sitting near recessionary territory despite markets at highs. I mean, what does it mean when the macro picture and the lived experience of the majority diverge this sharply? I mean, does that become a constraint on policy or a catalyst for instability?
So it's not necessarily a constraint on policy because, I mean, over the next 12 months or so, they can do practically anything. I think the next time it matters is the midterms. That's where these things tend to show up. They showed up in the prior election. They'll show up in the next election to varying degrees. I'm not a political analyst, but that's pretty clear. And that's the challenging thing for policymakers across the board is that when we look at the headline numbers, GDP and the overall labor market, there's no kind of ember defined recession, but it's because it's so narrow. So basically, you have a handful, like two main pillars holding up the whole thing, and the rest of it in isolation is pretty much in a recession. But that's one piece compared to these other pillars, and so you have that disconnect between concentrated stock market doing pretty good, nominal GDP doing pretty good, but the median person is saying, "Well, I'm not really feeling it."
Yeah. And I mean, going back to what you're just saying, you're describing an economy that's becoming narrower at the top, where a small slice of these companies and consumers keep the data looking healthy while the broader base seems to be weakening. We see that dynamic in emerging markets, as you just talked about, all the time, right? Strong headline growth with very fragile underlying breadth, I guess you'd call it. I mean, do you think that the U.S. is taking on those same characteristics as you put in your piece this morning? I mean, an emerging market-like structure where asset prices hold up even as real economic participation thins out.
Yeah, so when a developed market enters fiscal dominance, meaning that they're running structurally large fiscal deficits, and they also have very high existing public debt to GDP, meaning that higher interest rates, kind of blow out the interest expense of the federal government. When a developed market's in that position, it does have some emerging market-like properties. Now, it's got some other, things in its advantage. So I call it emerging market light. It's a more stable than a typical emerging market, but it does show kind of directionally similar signs. And one way to think about it is that when an emerging market has a recession, often the stock market is going up in local currency terms because their recessions are often accompanied with currency crises. So the currency is weakening, the stocks making highs in their local currency, but their stocks are doing poorly in dollar terms or gold terms. And if you look at U.S. markets today, the stock market over the past several years has gradually rolled over relative to gold, and that's despite all this AI fueled, stock market gains and spending. And so when you look at stocks priced in gold, it looks pretty much like you'd expect in this pretty low sentiment environment. But when we look at stocks priced in the dollar, which is debasing, then it looks pretty good because that's what happens when you have that more stagflationary type of economic malaise or that type of kind of fiscally dominant kind of a run it hot environment where it's the combination of a rising cost of living and kind of weaker wages and just kind of softer, not really collapsing, but softer job market. All those things come together so that there's this kind of multiple invisible levers of pain for the median consumer, even as some of the nominal figures continue to look fine.
Interesting. I like your terminology on that about it being light because, when emerging markets narrow, you typically see currency stress, yet the dollar, I mean, it's still firm and U.S. assets are still attracting that global capital. What's the catalyst that kind of forces this narrow structure to break if it does? I mean, does it take a credit event, a labor downturn, or, does it just simply grind to a valuation reset?
Yeah, good question. I mean, one is that the most of the developed world is in a similar bucket. They're not generally running as big fiscal deficits, but Europe's obviously got its host of problems. Japan's quite indebted, and so when you're looking at the dollar index, it's compared to a basket of other majors. Basically, all major currencies are devaluing relative to gold and relative to other most other scarce assets. The dollar has been pretty weak this year relative to other currencies. Most of that weakness was in the first half of the year, so it's been somewhat stable since then. Some of what's holding it up, of course, is we do have the AI spending. So if we had an economy that looked more like Europe without basically the U.S. economy without AI, that would look more like Europe. So that'd be kind of weaker. And right now, overall, basically, it's just that's the issue. It's concentrated. So, what could kind of threaten the existing structure? One is if the investor a base, so basically stock buyers and or bond buyers, if they do get more spooked by AI capex and they kind of perceive it more as a bubble and they want to lighten their exposure to it, that could create a vicious cycle to the downside, kind of like how we've seen a virtuous cycle to the upside. So all that wealth effect, or at least a portion of the wealth effect that investors have enjoyed over the past couple of years, could partially unwind, and therefore, ironically, kind of less enthusiasm about AI could result in less consumer spending at the upper income levels because their stock portfolios are doing poor. Other than that, you could see, for example, as the Fed gradually gets more dovish with rate cuts and potentially they've already ended quantitative tightening, as you said, but they could eventually go back to balance sheet expansion. You could get a weakening of the currency and a gradual rotation elsewhere, especially as we see. I mean, this year, like Latin American equities have done quite well. Emerging market equities in general have outperformed the S&P 500. So around the margins, capital's not really fleeing from those places into the U.S. anymore. It's just not really coming out of the U.S. So potentially the next phase is something could trigger at least some portion of that capital to want to go elsewhere.
Yeah, no, that's an interesting point. I mean, it talks about concentration risk to your point, because I was reading this morning, Moody's economist Mark Zandi summed it up simply with this quote: tariffs are the headwind, AI is the tailwind, everything else is being throttled. I mean, if AI spending cools in 2026, even slightly, as we just talked about, does the broader U.S. economy lose the only engine keeping GDP positive at this point?
I think it would lose one of the two main ones. The other one is fiscal transfers. So, very large Social Security outlays, Medicare outlays, interest expense, all defense, all these things. They do, largely flow into the economy. So that's going toward senior spending. That's going toward healthcare, and then by extension, the healthcare workers and their spending. It's going to the defense industry and their spending. Obviously, this is an issue for taxpayers and for currency holders, but it is a sort of like nominal stimulus on the economy. So basically, when you have most of the economy kind of held up by fiscal transfers and AI, if AI, goes away, then it's basically one pillar, and you lose kind of one of your two main legs. So it still wouldn't be like an outright just sharp reversal, but it would be a softening of an already soft situation by further concentrating it pretty much entirely down to fiscal transfers. Now, I don't really expect a major reversal in AI capex in 2026. I think the main risk would be a slowing. So there's basically projections of what it's going to be over next year, the year after that, and if those numbers are still positive, but they're just coming out on the softer side of expectation, then around the margins, that's just a weakening of the two main pillars.
Right. Yeah. That's fascinating, actually, hearing you talk about this fiscal transfers. I don't think many people think about it as a major support holding the system together, everything from stimulus era savings to expanded government. I mean, as we've seen, how much of the current GDP and market strength is simply a function of fiscal transfer activity? And if those flows slow or get politically constrained, as we've seen, I mean, what does that landing look like?
Well, it's somewhere around, fiscal deficits are somewhere around 6 or 7% of GDP, which is historically quite large outside of a recession. We're almost stimulating as though we're in a recession before there's any recession. And tariffs have taken a small bite out of that. But when you're running a $2 trillion deficit, and you have, you take, 400 billion in annualized tariffs away from that, it makes a dent. It's a macro relevant variable. But that's still in effect. So we've seen a mild softening of the fiscal side because of those, basically tax increases at the same time as we see AI. So right now, basically, if you factored out, if we did like a really quick tightening of the fiscal situation, you probably would see more normal characteristics of a recession. And so it's basically it's a difference between a normal kind of disinflationary recession and that more stagflationary type of recession, because the fiscal deficits don't work miracles. They mostly just pop things up nominally in what is already a very levered situation. So we kind of gradually see private sector debt shifting over to the public sector. It's the same process that Japan went through, except we're going through it as a twin deficit nation. So we're doing it with a trade deficit and a fiscal deficit, counterbalanced by the fact that we're the global reserve currency. So in some ways, we're more extreme than Japan and running into issues at a lower kind of debt threshold, but it's a similar playbook already out there.
Yeah, very interesting. And then we can get, I guess, to the Fed's kind of quiet pivot because it may be one of the most important stories of the month. I mean, on December 1st, we know that the Federal Reserve halted its balance sheet runoff. Quantitative tightening is effectively over. And based on liquidity data, it wasn't really a strategic choice. I mean, it seemed like it was a stress response to conditions in the repo market. I mean, did the market effectively tell the Fed, you're done? And does this confirm that the Treasury market can't function smoothly without a permanent Fed backstop?
Well, that's exactly what happened. They had been sucking liquidity out of the system. The combination of the Treasury general account filling a little bit above target because of the shutdown, combined with the fact that just there's kind of pockets where liquidity is and where it isn't. The Fed had to intervene with their standing repo facility. Now, to some extent, this was anticipated by the Fed about 2 years ago. They publish annual reports where they kind of project what their balance sheet's going to look like. And they're basically saying by around 2026, they're likely going to end balance sheet reduction and go back to gradual balance sheet expansion that's roughly in line with nominal GDP growth. Now, I think overall this hit probably a few months early, partially because of that Treasury general account issue. But it's really not that different from what they expected. So they've already had, a period of time of gradually tapering the rate of their balance sheet reduction. Now that they have this acute liquidity stress kind of tapping them on the shoulder, they've all out ended the balance sheet reduction. There are some talks about balance sheet expansion. That's still probably a little bit premature, but I think we'll probably see that in 2026. And again, it'll be in line with gradual GDP growth, most likely. It won't be some massive fiscal stimulus, or I should say a monetary stimulus. Instead, it'll be this gradual liquidity surplus added to kind of keep the wheels on. Because as you say, the treasury market pretty much needs that to function. The repo market needs that to function. Now, technically, there's other levers they can pull. They can, for example, ease the supplementary leverage ratio for large banks, which would effectively allow them to absorb more treasuries and to be able to perform more repo activities without running into certain thresholds. But that's something that the Fed will have to look at, probably next year.
Yeah. I mean, so in other words, the Fed anticipated, as you mentioned years ago, that this balance sheet reduction would eventually hit a wall and that they'd need to stop QT. I mean, with that, if this was expected internally, does that mean that the Fed has already accepted that the system can't run without a permanent rising, balance sheet? Is this the moment where those temporary tools quietly become more structural, you think?
Right. So before 2008, they had a structurally rising balance sheet already. The monetary base was structurally rising. That's how fiat system works. It's different from gold in that regard. Now, of course, the difference here is that they now with kind of post GFC regulations, banks run with much higher cash levels. And so the Fed's balance sheet is a bigger share of the GDP, but it does make sense that they're going to go back to gradually expanding that balance sheet, but from a higher layer. And this is one of the foundations of debasement. If in theory you had a fixed monetary base, that's what the Fed controls, the monetary base. If you had a fixed monetary base and banks make all these IOUs on top of it, whenever they run into problems, their number of IOUs would collapse, closer to the base amount, and people would risk losing deposits in their bank, and the banks, of course, would be at risk. And instead, the way that they operate the system is whenever they run into that issue, they instead increase the monetary base to keep most of those IOUs money good. And that's basically the difference between, say, a kind of a hard money gold system versus the fiat world we live in.
You've coined the term the gradual print, and I want to bring it back to this because the big print is obviously, we know you for it, Lyn. Obviously, we've seen you on the stages and we've been talking about it. But this new term, the gradual print, instead of massive stimulus waves, you argue that we're entering a phase where liquidity expands kind of slowly, roughly in line with the nominal GDP. If liquidity expands only gradually, does the cap, does that cap the upside for financial assets? I mean, what are we looking at in 2026? Is it going to be kind of a melt-up narrative investors want to believe, or do you think it's a slow grind?
Well, sentiment can dictate how fast asset prices move, because asset prices, of course, can move quite differently than underlying liquidity conditions. But generally speaking, that should, the bias is toward kind of a gradual increase. And for context, in 2019, there was a repo spike, and the Fed was kind of shifting. They ended quantitative tightening in response to it. They started shifting to kind of gradual balance sheet increases. They didn't want to call it QE. because they weren't doing it for economic stimulus and they weren't buying duration. They were only buying T-bills, and they were doing it primarily just to support bank liquidity. Now, and then of course, a few months later, when COVID and lockdowns hit, they went into like giga stimulus. But if you factor that out, that's basically that was kind of that liquidity thing that they were addressing. What we see here today is kind of a repeat of 2019, except hopefully without this kind of big lockdown or pandemic or war or whatever in front of us. So if you just have that environment, you're more likely looking at this kind of more gradual scenario. And the gradual print. I mean, the term there is so. I was on Natalie Brunell's show and I talked about this kind of gradual expectation we were going to see. Of course, my friend Larry Lepard has a book out called The Big Print. And so we're on somewhat different sides of how much balance sheet expansion we expect next year. If there's a really big stimulus, we can call that the big print. Whereas my base case is more toward a gradual expansion of the balance sheet, which they won't call a stimulus. They won't say it's for economic stimulus. They'll say it's for financial plumbing and technical issues. But really, basically, it's to support ongoing fiscal deficits and bank lending without allowing any sort of contraction to occur.
Yeah, yeah. So I mean, if the Fed is adding liquidity even gradually while inflation remains above target, I mean, aren't they just locking themselves into a path where inflation never truly resets? And I know we've talked about this before, but if CPI stays above 3%, doesn't any liquidity injection kind of work against their goal, or we just see this rinse and repeat?
Pretty much, yeah. They basically and that's the issue when they run into fiscal dominance, their choices essentially are either let inflation run hot or let the sovereign bond market potentially default and run into liquidity problems. That's really their two main choices. Like I mentioned, the third choice, which only works temporarily, is they could ease regulations on banks so they don't have to count treasuries and cash against their capital, which basically allows banks to lever up and buy more treasuries or perform more repo lending. So they have a handful of levers they can pull that either look like QE or shadow QE. But at the end of the day, they never let the bond market just go illiquid, and so they always err on more inflation, even when it's above target.
Yeah. Let's talk about gold for a second. I mean, obviously, it's a Kitco audience, so we got to talk about Bitcoin too. It's been impressive and somewhat disarming, a little bit alarming to watch. But I mean, gold is trading still above $4,000. But what stands out is the type of demand behind this move. I mean, you argue that it's not CPI trade; it's a collateral trade, right? I mean, is this breakout being driven by a shift in how global balance sheets think about safety? Are we seeing that rotation out of these long-term sovereign debts and into this sovereign metal?
So partially, it's not that we're seeing like a wholesale selling of treasuries by sovereigns, but we're not really seeing any much like net buying by sovereigns for treasuries. We are seeing net accumulation of gold. We basically seen that ever since 2009, but of course it kicked into high gear again after 2022. Because it's just, obviously concerns the countries have around their sovereign assets being frozen. Basically, are you really sovereign if you hold your reserves in a foreign security that can be frozen? So we've seen more interest in sovereigns repatriating gold that they already have claims to, as well as buying more tonnage. If you would have asked me last year, would I expect gold to hit 4,000 this quickly? I'd say probably not. I mean, my base case was just, back when we were at say 2,000 was to, get to 3,000. I didn't expect it to quickly go to 4,000, but as a bull, I'm happy to see it. I don't think it's overvalued, even though it is, potentially kind of technically overbought in the sentiment sense. And I think, but it's natural. Basically, we're kind of exiting the kind of the post World War II dollar bubble. That's kind of we kind of reached maximum dollar roughly around the year 2000, based on various metrics like dollars as a percentage of reserves. We've seen this kind of gradual shift toward gold reasserting itself back into the system, which I think is in the long run a healthier state of affairs. It's not really kind of sustainable to have countries on the world all buying the bonds of one country. That even hurts that country in some ways. All this kind of trade imbalance we see, the Triffin dilemma that's at play is partially because we are the reserve currency. So shifting back to neutral reserve assets can be a painful transition, but I think it's a more natural state of affairs. And so I think that a lot of these moves makes a lot of sense.
So I mean, sovereigns are preparing for a world where the U.S. remains the core of the system, but the margin of safety is kind of no longer trusted to the same degree.
Yeah, I would describe it that it's moving to a world where the U.S. is the biggest individual entity in currency reserves, but it is not the only game in town. So right now, obviously the two biggest economic powers are the U.S. and China. China's got a much stronger industrial base. The U.S. has a much stronger kind of capital markets and global reserve base. But around the margins, there's been a shift, a tiny bit into Chinese bonds, but primarily into these neutral reserve assets like gold. So basically, you have gold as a major reserve asset. You have treasuries as a major reserve asset. Around the margins, you have other major developed fiats as reserve assets. And that's just in general, it's a more balanced system than basically having 80% of all assets stuffed into U.S. markets.
Yeah, yeah. Well said. Okay, so you didn't expect gold to climb as high as it did, as quickly as it did, which I think a lot of people felt the same way. Lyn, I mean, what about Bitcoin? Were you expecting that haircut? Were we expecting that high and then to see this nice little, correction, I guess we could call it? What are your thoughts?
Well, Bitcoin's always like more volatile than people expect. I mean, I
Yeah.
would have liked to have seen 150K this year. We only got to 126K, which is not too far off, but it's a little bit on the disappointing side. In general, I think there is a little bit of treasury, like those treasury companies. Some of their MNAVs, their market value to net asset value, got a little bit excessive. We also started to see altcoin treasuries, which I don't think was a particularly healthy development. So I think it's natural for a lot of that space to get washed out. Even though some of the leading ones I think are healthy overall. They have pretty low debt to Bitcoin ratios. So I think as we see that right size, as we see some selling, I also think there's kind of a self-fulfilling prophecy. So Bitcoin hit a multi-year peak in Q4 of 2013. Then it hit another major peak in Q4 of 2017. Then yet another major peak in Q4 of 2021. Basically, it's kind of in line with Bitcoin's kind of 4-year supply halving cycle. So I think investors are spooked that if it didn't reach their targets here in Q4 2025, that they might have to wait multiple years for their next run. That's where I would generally disagree, and I think that we're no longer on a 4-year clock. So I think there's some selling that basically fear that we are, but there's no particular kind of supporting reason that cycle would still be in effect. So I do think that in the next couple of years, I think Bitcoin is still well positioned, and right now, basically, a lot of the leverage and sentiment has been washed out of it.
Yeah, you brought up strategy. I have to ask you, I mean, it's kind of the elephant in the room as we kind of go about it. I mean, the stock has been obviously extremely volatile. The premium kind of collapsed, and analysts are openly questioning the balance sheet risk. I mean, it's a company with billions in leverage tied directly to the Bitcoin's price. I mean, how concerned should investors be about concentration risk there? I mean, does the strategy model work in an environment where liquidity is tightening and the ETF market now absorbs most of the institutional flows? Or is the market kind of finally just repricing the idea that a corporate balance sheet can function as a Bitcoin hedge fund?
Well, I think they're repricing it. I mean, I don't think that the 3 times MNAV it was trading at was sustainable. I mean,
Yeah.
there were other ones trading at even higher MNAVs, like Metaplanet was at something like an 8 times MNAV back in June. I don't think those levels are sustainable. I do think that Bitcoin with non-callable leverage attached to it, the type that corporations can issue, is pretty attractive and can warrant an MNAV above 1. But there's a kind of a range that makes sense, and I think that a 3 times MNAV doesn't really make sense. So there's been a repricing. And I still think the business case itself makes sense. I would like to see more of these treasury companies have cash flows to support their interest expense. But when you look at how most of them are structured, the top ones like Strategy or Metaplanet, they've got pretty low debt relative to their assets. During the bull market, MicroStrategy has something like 20% debt and preferreds as a percentage of its Bitcoin. Now it's a little bit higher because Bitcoin's gone down, but
Yeah.
even their preferreds are not, exactly debt,
Yeah.
and so the actual debt portion is still quite a low percentage of their Bitcoin holdings. So it's fairly conservative leveraged, but it does make sense that investors would be spooked when they're holding it at 3 times MNAV or even when it back down to 2 times MNAV, that they'd want to kind of right size that position. So I think we've seen kind of this over euphoria in the space. I think there's going to be there's an ongoing washout of the weaker ones, the ones that were kind of poorly capitalized or poorly run, or bet on the wrong asset. But I think as it kind of washes out, I do think that a handful still makes sense as long as they're conservatively run. And of course, the differentiation they have compared to ETFs is that if an investor is bullish, they can buy unlevered Bitcoin, which I think makes the most sense. You generally want to have your core position be unlevered. Ideally, you can buy it and take it into self-custody. But if you're the type of investor that's going through a brokerage account, the ETFs are very useful. But then for bulls that want a little bit more leverage, it's still conservative leverage, but it's some leverage. And so it is a differentiated security than you get from an ETF or from owning the underlying itself.
Yeah, well said. And I guess that brings us to your new letter, because this section will surprise a lot of people. I mean, you argued for most cryptocurrencies outside of Bitcoin, obviously utility is not a bullish trait. It's more of a trap, because once a blockchain becomes purely a utility rail, it competes like a commodity. Fees fall, margins compress, and returns vanish. You compared this to the ETF industry, trillions in assets, but the issuers capture very little value. Are you saying that the high utility is actually kind of bearish for a token, that these networks will be very useful to society, but terrible long-term investments?
Pretty much. I basically would say that puts them in the category that look more like equities. So, from the beginning, I've been bullish on Bitcoin, and I've been bullish on the growth of stablecoins. But that bullishness doesn't really extend to other cryptos. That doesn't mean that there's still not some that are useful. I mean, obviously, there's some things serving as the tech rails for the stablecoins and other types of assets. But that my argument is that the overall market value of those is unlikely to grow very large. As evidence of that, I mean, if you look at the ETF industry, there's over 13 trillion of ETF assets that are, basically a handful of companies issue the majority of them, and those companies are worth less than $200 billion. It doesn't take a lot of kind of operations to run this really big platform. And the same thing's true for the big stock exchanges in the world. The company, the two companies, New York Stock Exchange and NASDAQ, that are responsible for the vast majority of U.S. market cap, tens of trillions of dollars. To collectively, they're worth less than like half of Ethereum. And so when people look at these crypto assets and they say, well, this is going to serve as the tech rails for billions or trillions of dollars of stable coins and trillions of dollars of tokenized, whether it's real estate or art or equities or whatever you have it, the numbers that they have to reach in order to make these things worth what they already are worth are extraordinarily high. If you look at them on any sort of revenue basis and kind of treat them as though they're a tech equity. And so basically there's a lot of competition between utility protocols. I think you price them like those tech rails. And the only one that I think is basically worth being a multi-trillion-dollar asset is potentially Bitcoin, because that's the one that's bought for its own sake. It's bought because people want to hold Bitcoin. They want the leading network effect and security for portable capital. So that can potentially warrant it as long as it remains decentralized and secure, and kind of the best at what it does. But outside of that, I think the valuations are quite high.
Yeah. You brought up Ethereum. I mean, in your view, is Ethereum simply priced for kind of a monetary premium it'll never earn here? I mean, if ETH ultimately functions like a toll road with fees constantly competed down, I mean, how does that justify the valuation on par with the world's largest financial exchanges?
I think it doesn't. I mean, right now it's partially held because it does have that kind of speculative or monetary component to it. But yeah, when we look at what could realistically in size run on Ethereum compared to what already runs on top of ETFs and compared to what already runs on the world's major stock exchanges, even if all of that ran on Ethereum or ones like it, Ethereum's already priced bigger than all of them. I do think that there's still a kind of a speculation premium on the leading crypto assets. Obviously when liquidity is good and Bitcoin's good, those assets are also generally doing fine. So it's not that they're not tradable, but that I don't really see a compelling reason why you'd want to hold them for 5+ years in a similar way that you might do with Bitcoin, similar way that you might do with precious metals, similar to what you might do with high quality equities or real estate.
Yeah, interesting. I mean, ETH bills would say to me, and I would get the tweets, right? I mean, yes, fees compress, but Ethereum secures trillions in on-chain activity. It kind of powers that stablecoins, that RWAs and tokenization. Utility should kind of command a higher valuation. At least that's what they argue. Where's the flaw in the argument? If the network becomes more efficient, doesn't that reduce Ethereum's value capture even further? I mean, does scaling actually work against the token long term?
I would say it's mainly a size issue. So it is true to say that whatever rail runs things like stable coins or a little bit of DeFi and things like that is worth something. But basically, we're talking right now running hundreds of billions of total locked value compared to these other things that run literally tens of trillions and are trading at less than Ethereum is trading at. Basically, you don't need a $300 billion asset to run, $1 trillion in activity or even 10 trillion in activity. And so basically, there's still a very big kind of monetary and speculative premium attached to it. And so when you just price these things like you do price existing rails, it's already expensive. So it's basically just it's a question of magnitude, in my opinion, rather than the separate question of is it worth anything if something runs on top of it. And of course, the answer to that is yes.
Yeah. And then, of course, there's Bitcoin, the big one. I mean, it's corrected sharply, as we've talked about from the highs. But I don't know if you heard about this from BlackRock CEO Larry Fink. He was kind of talking about how sovereign wealth funds are buying the dips. They're not trading it. They're accumulating. What's happening with the price? I mean, why is it falling if sovereigns are accumulating? Is it just a leverage washout? I mean, is market liquidity still too thin for institutional flows? I'm just kind of looking for an outlook going into next year.
Well, sovereign buying, from what we've seen, is fairly low. It exists, but it's not particularly a massive driver. Um, the major source of selling has been long-term holders, which happens in every bull cycle. So whether you look at 2013, 2017, 2021, or now, and even last year, when Bitcoin does really well and it's very liquid and the price is reaching new highs, you generally have a lot of people that have been holding it for 5, 10 years, where Bitcoin might have been worth 5% of their net worth, and now it's 50% of their net worth or more because it's appreciated so much. You'll generally see some of them selling some of their position. It could be because they want to rebalance and have less concentration risk. It could be because they start a family and they want to upgrade their consumption, their overall kind of this lifestyle, and so they're selling some of their assets. So you kind of get that normal distribution. It's kind of like how when a startup company happens, you have a handful of inside owners, then you have a handful of VCs. It's pretty concentrated ownership. But as the company grows very large and becomes publicly traded, you get selling from those early owners and investors, not necessarily their entire position, but some of their position in order to consume or in order to rebalance. And you see buying from outside entities. So basically, this whole bull market has been driven by people buying through ETFs, people buying through these treasury companies like Strategy. Of course, a handful, some people buying the coins directly and taking them into self custody. But then on the other side of that, there has been, a couple million coins being sold by these longer term holders that kind of take advantage of the liquidity and the strength in the market. So it is still a volatile market, and there's still overall distribution and change of ownership occurring.
Mm-hmm. Yeah. And I mean, I guess the fiscal reality of what we're dealing with in the US is part of that bullish sentiment. I mean, US federal debt is approaching $38 trillion. Interest costs are about $1.2 trillion a year. There's this debate inside Washington. Kevin Haas obviously says tariffs will materially shrink the deficit. Treasury Secretary Scott Bessent calls tariff revenue a shrinking ice cube. I mean, who has the economics right? Can tariffs meaningfully, I guess, offset the interest bill, or is it just the U.S. already in a structural deficit trap?
Right. Well, it's a tax increase. So basically, they added a tax increase. Now, normally Congress is pretty polarized, which would prevent tax increases, but because they used emergency powers, they were able to do a tax increase without Congress. Obviously, the Supreme Court is kind of in deliberation about that. So we'll see the longevity of the tariffs and if they have to reconfigure them in some way. Of course, around the margins, therefore, it is a reduction in the deficit. But as I mentioned before, it's something like a $400 billion reduction in a $2 trillion deficit. So it doesn't really reduce the deficit meaningfully. It just kind of slows down the growth of that deficit, while also burdening the entities that are on the wrong side of it. And that's part of how you have this kind of two-speed economy, because you have some entities that are they're on the receiving side of fiscal spending. And you have other ones that are either squeezed by tight monetary policy or they're squeezed by tariffs in some way. So far, there's no major shift toward building manufacturing facilities here. When you look at overall manufacturing spending, it's not really higher currently than it was a year ago. And so pretty much everything is driven by AI capex spending, not really that kind of manufacturing shift. And so right now, it's basically a kind of a tax increase that doesn't really have any major offsets.
Yeah. Lynn, our time always goes so darn fast, but I got to ask you about private credit because signs of stress are starting to emerge. I mean, margins are collapsing, banks are undercutting direct lenders, and the sector is far larger and more interconnected than in previous cycles. So, I mean, are we sleepwalking into a credit event in private markets? Is private credit maybe an underpriced risk of 2026 in your thoughts?
It's a good question. I would separate kind of two concepts here. One is I do think that private credit is at risk. I would be nervous if I was a private credit investor. There's been rather kind of high degrees of speculation there. Basically, as banks have been quite heavily regulated, a lot of this kind of, a little bit more aggressive lending has happened in this, private credit shadow banking industry. But the other comps that I would separate is that the overall size of the private credit market, despite being bigger than it was years ago, is still fairly small when you look at the kind of the whole economic pie. In addition, banks generally have decent safeguards against taking too much hit on their capital. So a lot of the things that private credit is lending against, there's pretty substantial buffers for collateral and things like that. So the private credit funds would have to generally take very big hits before any material amount of that would spill into banks. And then banks also have a pretty large buffer of capital. So I don't really see this spilling into like a macro impact on the banking system or the broader economy too much. Other than we are talking about a multi-$100 billion industry that could run into frictions and obviously hurt the areas that it's impacted by. So that is kind of one potential headwind against the wealth effect, is if you have large institutions and wealthy investors taking hits on their private credit portfolios, overall kind of illiquidity there. But yeah, I don't really view that as spilling into the broader thing. I think that overall probably tariffs are a bigger factor because we're talking about 400 billion in annualized new taxes, as well as kind of some of these Fed moves and potentially other fiscal things. That's kind of where my primary focus is on, with the private credit situation being something I'm observing but wouldn't really place in my top three.
Okay. All right. Well, then let's talk positioning in that kind of macro setup. I mean, you trimmed high growth names like TSMC and AMD, rotated into companies like PayPal and Accenture. I mean, is this that simply kind of valuation discipline, or is it a defensive shift ahead of what you expect to be a slower 2026?
Yeah, it's mostly a valuation shift. Basically, I'm bullish on revenues of those types of companies, but they had doubled in a very quick period of time, which is great when you're long. And so it was me kind of locking in some of those profits. The same thing with Alphabet. It got rather extended. There was a while where people worried it was going to get disrupted by AI. It turns out it's also one of the beneficiaries of AI. So I've been long that, but as it kind of quickly doubles, I'm more nervous for valuations and overall capex spending. So for me, it was just a slight rotation out of these high flyers into some of these more conservatively priced names for a fairly small percent of the portfolio. But basically, yeah, I do think investors maybe want to be a little bit concerned around concentration risk next year, which is different than saying I'm outright bearish on those assets, just that I want to do some risk management.
Yeah, well said. And what's the closest thing? I mean, what are you watching closest that kind of people miss? I mean, what's the one word for 2026 that could like define the year,
The one risk I would say is probably AI capex. That the stock market is really kind of held up by these big mega caps. They've been relying for a long time on high ROI. So they make a lot of money with kind of moderate outlays to data centers and things like that. It's very software based, very kind of focused on network effects. They were able to therefore to put a lot of that capital towards share buybacks. And now that era is kind of behind us. Now it takes a lot more spending to maintain the leads that they have. So potentially less money going into buybacks. And just overall kind of that flywheel is a little bit more likely to be impaired in the years ahead, which is not necessarily a bad thing when you have that kind of concentration and constant buybacks. But it is a changing market condition that I think investors should have to be aware of.
Yeah. What a year it's been, huh? Like looking back at last January, there's a lot of these that we couldn't anticipate kind of covering throughout the year. Anything surprised you the most?
Not any one thing. I think just the magnitude of certain things. Like I said, I was and still am a gold bull, but I would not have kind of hoped it would hit 4,000 this year, maybe in the years ahead. So I was glad to see that kind of do better than I expected. Same thing with the rest of the precious metals complex kind of finally catching up over time. So that's been nice to see. We've seen kind of outperformance of certain international segments. Some of them did even better than I would have guessed, like Brazil, for example. And so overall, it's mostly just a little bit surprise of magnitude. When things change, they tend to change even quicker than you think, even if you're kind of expecting some of those changes.
Yeah, well said. All right, Lyn Alden, always insightful, always generous with your clarity and your time. We appreciate it. Thank you for being here today with us.
Thank you.
Thanks, Lyn. All right, if you found today's conversation valuable, make sure to subscribe to Kitco News and turn on notification. It helps the channel grow and ensures you never miss interviews that move markets. Also, a big thanks to our sponsor, Swan Bitcoin, your partner for generational wealth. You can get started at swan.com/Kitco. I'm Jeremy Szafron. Thanks for watching. Keep it here.
Swan is the premier Bitcoin wealth platform serving leaders of families and businesses. Swan's mission-driven team simplifies Bitcoin investment, custody, and security, bringing you concierge service, world-class research, and exclusive events.